How did currency devaluation strategies impact investors? Imagine waking up one day to find that the money in your wallet is worth less than it was yesterday. This is the reality of currency devaluation, a strategy used by countries to adjust their economic standing. When a nation decides to devalue its currency, it reduces the value of that currency compared to others. This decision can have a ripple effect on investors, creating both challenges and opportunities. One of the most immediate impacts of currency devaluation is on exports. When a country's currency is weaker, its goods become cheaper for foreign buyers. This can boost sales and stimulate economic growth. However, for investors holding assets in that currency, the situation can be tricky. The value of their investments drops when converted back to stronger currencies, leading to potential losses. Historically, governments have turned to devaluation to fix economic issues like trade deficits. A notable example is the devaluation of the British pound in 1967, which lowered its value by about 14%. While this aimed to improve competitiveness, it caused immediate losses for investors holding pound-denominated assets. Such actions often create uncertainty in the market, as investors reassess their expectations regarding currency stability and inflation. For investors, the effects of currency devaluation can be seen in several areas. First, foreign investment returns may shrink. If an investor has exposure to foreign currencies, a weaker domestic currency can diminish returns. On the flip side, investors in the devaluing country might see benefits if the devaluation boosts corporate earnings. Next, inflation and interest rates come into play. A weaker currency can lead to higher import prices, which can fuel inflation. Central banks might respond by increasing interest rates, affecting bond prices and borrowing costs. This can change how investments are valued. Additionally, devaluation strategies can lead to capital controls. Governments may impose restrictions to manage currency demand, impacting liquidity and the ease of moving funds internationally. Investor sentiment can fluctuate during these times as markets react to government policies and economic forecasts. Another aspect is competitive devaluation. When multiple countries devalue their currencies to gain trade advantages, it can spark what some call currency wars. This increases volatility and uncertainty for investors across the globe, making risk management essential. In practical terms, investors often respond to devaluation risks by diversifying their currency exposure. They might invest in assets that are less sensitive to currency changes or seek hedging instruments to protect their investments. Understanding the broader economic context, such as domestic policies and exchange rate systems, is vital for anticipating how devaluation might affect investment portfolios. Currency devaluation strategies create a complex environment for investors. They must weigh the potential for gains from increased export-driven growth against the losses from reduced currency value and heightened economic uncertainty. These dynamics have shaped investor behavior and financial markets throughout history, reflecting the ongoing relationship between national economic policies and global capital flows.